There were very important changes in the U.S. stock market today. All three major indexes, Dow Jones, S&P 500, and Nasdaq, ended in the green zone. The Dow Jones alone jumped more than plus 650 points. The main reason for this is investor expectations that the Federal Reserve may cut interest rates in December. The economic numbers that came out in the past few weeks have been moderate. Since retail sales, consumer spending, producer price index, etc. came in the soft range, the stock market believes that inflation pressure is decreasing. The fall in bond yields further supported the market. Yield drop is always a plus point for risky assets. So tech, retail, and industrial stocks all showed good momentum. This rally is not a temporary bounce, but a calm upward trend due to future policy expectations. The market tone is cautious but positive throughout. The most important reason for the U.S. stock market to move higher today is investor belief that the Federal Reserve may soon cut interest rates. All the U.S. economic data released in the past few days has shown softening signals. Retail sales are not as expected, consumer spending has decreased, and the producer price index, PPI, continues to slow down. This is a big signal to the Fed and the market that inflation pressure is gradually weakening. Inflation is soft, but the Fed may cut interest rates. Based on this belief, bond yields fell sharply. When yields drop, investors automatically shift towards stocks, especially growth and tech companies. At the same time, labor demand cooled down in some areas. The Beige Book report clearly stated that economic activity is largely unchanged, but consumer demand is soft. This has created hope that the Fed may switch from an aggressive stance to an accommodative stance. This overall macro setup is what has put the market in the green zone today. Today's U.S. financial sentiment was determined by the Federal Reserve Beige Book. The report provided an economic snapshot of the 12 federal districts across America. The most important observation was overall economic activity largely unchanged. This means that the U.S. economy is slowing, but the recession is not imminent. The Beige Book also makes one thing clear about consumer spending. People's spending is noticeably weakening. Retail stores, restaurants, and travel sectors all reported soft demand. This is a positive sign that inflation is naturally cooling. The labor market is also changing. Hiring demand has slowed in some states and wage growth has flattened. These three factors, weak spending, softer labor, and stable inflation, send the Fed an indirect message that rates cut is safe. So the rate cut probability at the December meeting has started to move above 83%. This policy expectation is the main reason for today's market sentiment to turn green. Despite the mixed performance of the tech sector behind today's U.S. market rally, the overall movement was positive. Big tech companies like Apple, Microsoft, Amazon, Meta, all of them showed moderate gains. The reason is simple: if interest rate cuts come, borrowing costs will decrease, and valuation support for tech companies will increase. At the same time, some AI and semiconductor stocks like Nvidia, AMD experienced volatility, as news flow related to the demand cycle and competition was mixed. But investors did not forget to dip buy on a large scale. Not only tech, cyclical sectors, retail, consumer goods, industrials showed good strength today. This is a very important signal. The market is shifting to broader participation. The market has been purely tech-driven rally for the past few months, but today's steady upward trend of consumer-facing companies indirectly shows that the U.S. economy is somewhat stable. Financials and bank stocks also had a mild recovery, and despite net interest margin pressure due to yield drop, overall sentiment is supportive. This sector rotation is seen as a healthy sign for long-term investors. Today's U.S. market rally had a direct impact on global markets. The expectation that the Federal Reserve may cut rates soon immediately uplifted global investor sentiment. Asian markets, Japan's Nikkei, Hong Kong's Hang Seng, India's Nifty futures all traded with a positive bias. The reason is simple: U.S. rate cuts mean the dollar value is soft, funds inflow to emerging markets will increase. The same momentum was also seen in Europe. Indices like the UK FTSE and Germany's DAX reflected cautious optimism. The movement was also clearly visible in the commodity market. Although gold is close to the high of the past 2 weeks, today there was a small dip due to profit-taking. But the overall trend is safe haven demand is strong. Oil prices were in a stable to slightly up range, and volatility has decreased due to geopolitical tension. The dollar index showed slight weakness, which is a relief for global currency markets. This whole setup, US yields drop plus dollar weakening plus stable commodities, created a supportive environment for global investors. This will also improve emerging market performance in the coming weeks. Analysts say despite today's US market rally, there are some key risks that investors should be aware of. The first risk, inflation data. Even if the numbers released now are soft, any new inflation spike will immediately shatter rate cut expectations. As a result, bond yields could rise again and the stock market could face a sharp correction. The second risk, tech sector valuation. Some AI and cloud companies trade at very high valuations. There is a possibility of a big sell-off if competitive news or earnings misses come. The third risk, consumer weakness. As the Beige Book already said, US consumer spending is becoming soft. This will put direct pressure on corporate revenues in the long run. The fourth risk, geopolitical disturbances. Oil supply shocks, Middle East tension, or an unexpected global event could immediately stop the market rally. The last, Fed communication risk. If the Fed gives a hawkish tone at any meeting, the markets will react immediately. Overall, although sentiment is positive, if any of these risk factors are activated, the green trend seen today could soon change.